Friends, welcome to our today's session. So today we are planning to learn few insurance products. Of course, we know what the insurance industry broadly we know products can be classified as life insurance products and non-life insurance products, and some of the basic insurance policies. Today we'll be learning few of them. So let me share the screen with you. Give me a moment for that. So not only we'll see the product, we'll also learn about their applicability. That means in which situation the products are relevant or these products are useful. That also we'll have some idea of that. Well, friends, so this is about insurance products and their applicability. So one by one we'll be learning. First of all, few specific things we are going to learn. If you look at our syllabus, so this is what we are going to learn, like pension plans, Bancassurance, ULIPs, endowment plan, and money back plan. So we are going to cover all these areas. So first of all, we'll try to understand what is pension plan. When we talk about pension plan, normally what you understand that employee will be getting some pension. What happens in many organizations? The employer contributes some money to a fund. Sometimes employer contributes and employer also collects some money from the employee and jointly they contribute. A fund is created so that after retirement, that employee can get a fund or employee can get a regular income. This is the kind of normal pension plan. And this kind of plan can be monitored or can be managed through insurance policies. Okay, all of us know what is pension, right? So it is basically an employee benefit plan. But even if someone is not an employee anywhere, that means someone is not on job, let's say he is a self-employed, still he can address these pension related issues by taking an insurance policy. The insurance policy will be helpful in that regard. So therefore, there are specific insurance policies which are intended to cover, or you can say they are related, they can be called as pension plan insurance policies. Okay, if you take a policy like this, so it will give you a dual benefit. Dual benefit means, first of all, it is an investment device. You are contributing premium regularly, and at the end, you are getting maturity value. Maturity value in terms of a pension you are getting. That is one thing. In addition to that, it also gives you insurance coverage. That means in case the insured dies, then the nominees will be getting the sum assured. So that is, you can say both the things are covered. It gives you an insurance coverage and it also gives you an investment option. So under these schemes, what happens? The insured invests a certain sum of money regularly towards a pension plan. And as the investment goes on, as the insured keeps on paying premium, a fund is created by accumulation of these premiums. Okay, suppose insured is paying monthly or annually or quarterly, a fund is created and the insurance company invests that fund in some dedicated investment options, and the fund's value increases, so the fund's value is created, and at the time of retirement, this same fund, whatever money is available, that is distributed to the policyholder by way of pension. Okay, so this kind of investment offers a steady flow of funds, or you can say steady flow of income to the person who has taken that policy. So one can plan his insurance, we can plan his pension plan by taking a policy like this. So if he plans it early, say he starts contributing early, then naturally this fund value will be more. Pension fund will be, you'll be getting a bigger fund. Okay, so it is better to start contributing at an early stage so that the size of fund will be big. And there are various insurance plans are there. Different insurance companies provide various plans. So one have to carefully choose which particular plan suits him. And if a plan is carefully chosen, then there's every possibility that it can help to rise above inflation. That means you can get a return more than the rate of inflation. This is possible because of compounding effect. Fund is invested or premium is paid, and that investment is made, or you can say that investment gets compounded, so the value of the fund increases. So this is about insurance plans. Further, if you know, there are few other benefits of this kind of plan is that one can get tax benefit. Tax benefit is that the premium paid to this kind of funds are eligible for deduction under income tax law. Right. So up to 1,50,000 is a normal deduction, and certain specific pension like national pension scheme and a certain type of NPS, then additional 50,000 rupees is also deductible from the gross total income. Consequently, what it gives you is a tax benefit. Right. So when one person is choosing that plan, he should ensure that it is in line with his investment goal. Right. He's investing money by your paying contribution. After that purpose is that he can get a pension. Pension can be commuted also. Pension can be received in lump sum. Pension can be received periodically also. That is also choice depending upon the policy one takes. Okay, so one has to smartly choose a retirement plan to meet his needs. If you look at this slide, you can see these are the various typical plans are there. These are the various types of pension plans available in the market. One uses the deferred annuity plan. On the deferred annuity plan, what happens? A systematic premium or a lump sum premium is paid over a tenure. There is a 10 years, 15 years. Either a lump sum money will be paid or a systematically, periodically, this premium will be paid. And pension begins after end of that term. Suppose 15 years you'll be contributing, after that pension will begin. Or will pay a lump sum, after that pension will be beginning. This is called as the deferred annuity plan. Similarly, immediate annuity plans are also there, where lump sum investment has to be made and pension will begin immediately. Right. Then one more plan is that annuity certain. Annuity certain means the period of pension will for a certain period. Pension period is certain. It will not go on indefinitely. That is called as annuity certain. Then with cover pension plan. With cover pension plan, what happens? Policy holders dependents are entitled to lump sum. Right. That means person will get pension. In addition to that, the dependents are also covered. They will be getting lump sum the moment the policyholder dies. Then one more plan is that life annuity pension plan. Your pension continues till the death, and it can be with spouse option also, without spouse option also. That means after the death of the person, spouse can also get pension. National pension scheme, which is monitored by central government, is again a beautiful scheme for pension. Okay, so money can be invested in this scheme, and in fact, government invests that money. Government collects through premium, and government invests that money in equity market and debt market as per choice given by the investor. Okay, one can also withdraw 60% of the money when he retires. The rest money can be used to buy annuity. Okay, tax will be levied on 20% of the corpus that you withdraw upon maturity. So this is a typical scheme. But it's a good scheme which is monitored by central government. All these things we are talking about are called as the, you can say, retirement plan or pension plan for this. Pension fund, this is another kind of pension plan, and this fund is monitored by Pension Fund Regulatory and Development Authority, which is called as PFRDA. Okay, so they also sell pension plan options. They got various you can say institutions which deal with that. The State Bank of India is one of the institutions which sell pension funds and regulated under PFRDA. One more kind of pension policy is there, pension plan is that guaranteed period annuity plan. The annuity is disbursed for a specific term, like 5 to 20 years, and specific guaranteed amount will be paid as annuity. That annuity can be treated as a pension. So these are, you see, various kinds of pension plans available in the market. Of course, different service providers have their own scheme. It has got various benefits, and you can say these are the features of pension plan. There is a guaranteed pension or guaranteed income post retirement. It is tax efficient because one person can save tax. It is also liquid if required one can withdraw money. It has got a vesting age that for a specific period one will be receiving pension. Until that time, the contributions paid and the premiums paid keeps on accumulating. So over a fixed duration, money keeps on accumulating, right? So after that, money will be paid, and it has got a surrender value also. That means if you want to close the money, it will be also getting one lump sum. This is about pension plan which we discussed. I think this is clear. It's a very popular plan. I think it's clear to you. In case you have any query, you may raise your hand so that I can get a message that you want to ask something. Now, next, no query. Next type of pension, next kind of insurance policy we are learning about endowment plan. Of course, we have discussed about this plan in one of our earlier classes also. So this is again very popular, and most of the policies we take, people take, belong to this category. So it is in fact a life insurance policy which provides you a combination of insurance cover as well as saving plan. Okay, that means typically what happens under this policy, money is invested by way of paying premium. So it gives you some return at the time of maturity. And in case person dies, so compensation is paid. Compensation means the maturity value as the sum assured is paid to the nominee. Right. And this policy earns income in the sense where the money is invested by the insurance company and insurance company pays bonus on it. So therefore, it is an investment vehicle, and also it has an insurance coverage is also there. Okay, so the policyholder gets some assured at a fixed rate in case he is surviving till that, and in case person dies, then in case of sudden death, the sum assured plus bonus will be paid to the nominee. So this is about endowment plan. And different types of endowment plans are there. Some of the endowment plans are unit linked. That means the money will be invested. Unit link means money will be invested in some insurance policy. Sorry, in some mutual funds. Right. So the premium which is contributed, partly it is applied for insurance and partly it is applied for investment in mutual funds. Therefore, it is called as unit link. You know that mutual fund are sold through units. So this units money is invested in these mutual funds. So that is why it is called as unit linked endowment. Or full with profit endowment plans. Here what happens? Bonus are also declared, meaning the policyholder also gets a part of the profit of the insurance company. How that profit is distributed? Profit is distributed by way of bonus. Policyholder gets a bonus. Low cost endowment plans are in fact small endowment plans, small policies. Okay, so here what happens? It allows the policyholder to accumulate the money and pay premium periodically. And there is one more category of endowment plan, which is non-profit endowment plan. Here, the policyholder is not entitled with the profits of the insurance company. That means no bonus is paid. So now you have understood endowment plan can be unit linked. That means a part of the money can be invested in mutual funds. Right? The insurance company will take care of that thing. Insurance company will invest that money in part of that money in mutual funds, and policyholder will get the benefit of that. It can be full or with profit endowment where policyholder is entitled to this thing bonus. It can be non-profit endowment with policyholder is not entitled to bonus, and it can be low-cost endowment also. That means it can be very small policy with lower premium. These are the endowment plans. Okay, it has got these features. Okay, first of all, death with survival benefits, both are covered. In case of death, some asset will be getting, survival is some maturity money as well as bonus will be paid. Return is high in compared to other policies. Premium payment frequency can be changed depending upon the need of the policyholder. Okay, it has flexibility in cover certain additional things like illness coverage, permanent disability coverage, and accidental death benefits can be included in the policy. It also gives you tax benefit. That means under 80C, Section 80C of the Income Tax Act 1961, one can claim deduction from the gross total income on the premium which is paid for this policy. Under this policy, the risk is also low because insurance company invests this money mostly in mutual funds, not directly in the stock market. Therefore, insurance company takes low risk, and consequently, the policyholder's risk is also less. So these are the features of an endowment plan. Yeah, I think this is also clear to you. Next kind of insurance policy is unit-linked insurance plan or ULIPs. Okay, here what happens? This gives the investor, you can say, it satisfies two goals of the investor. One is investment as well as insurance. As we are discussing in unit-linked insurance policy, just now unit-linked insurance endowment policies, that means the part of premium will go for investment. Investment means investment in mutual funds only. But of course, you can decide whether it can go to the debt fund or it can go to the equity fund or it can be a balanced fund. That investors can decide, but it will be invested in mutual fund. And the other part will be used for insurance purposes. Okay, so it provides a life cover and also gives the benefit of the stock market of debt funds, equity funds, etc. So the first, this kind of policy, first ULIP was had come in the year 1971 by Unit Trust of India, and then by Life Insurance Corporation in 1989. Now you see almost all the insurance service providers are offering this kind of service. A portion of the premium is diverted towards investment in mutual fund, and other portion is kept for meeting the insurance requirements. And once you've chosen a particular fund, let us say debt fund, equity fund, or hybrid fund, mix of debt and equity, money will be invested in that fund. And if you want, you can switch over also. Let us say first 6 months you decided money will be invested in equity fund. Then you decided to reduce the risk, you can switch over to debt fund. Then you can move to hybrid fund. Then also you can switch over from hybrid to equity. Like this, in between you can change the funds. So these funds are basically mutual funds where your money can be invested. So this option is available.
Sir, in this fund, sir, the one who has taken the insurance policy, he doesn't have to think anything about the investment plans.
No, initially he has to give an option that where the money is to be money is to be invested. Later on, if he wants to change that, you can switch. Okay, he can switch. Okay, he can do that. The person who is investing initially must have given an option. After that, he can change at any point of time. He can change this option.
It is upon the policy holder.
Yeah.
Where he wants to invest.
Yes. Yes. Okay. Thank you. And normally, this kind of policy has got a lock-in period. That means during this period, you cannot withdraw that money. But ideally, it is always suggested that if you are investing money in this fund, you need to invest it for a longer period. Then only you can get the real benefit of this policy. Then only you can find that wealth is actually maximized over this longer period of time. Because initially, most of your premiums are applied for the charges or certain other costs, management costs of the company. So therefore, very small portion of your premium part is actually invested. But if you keep it for long term, let us say for around 20 years, you'll really get the benefit out of this fund. This one aspect one has to take care of. And these are the funds, equity funds, debt funds, or balance funds. These are the funds where the premium money can be invested. Equity funds means funds will be invested in mutual funds, and mutual fund will be investing that money in the equity market. Okay, this is little risky, but this will give more reward also. Debt fund is a secured fund. Money will be invested only in debt securities like government securities, bonds, etc., money market securities. So return will be less, but risk is also less. Balanced fund means it may be 50-50, 50% in equity market or 50% in debt market or 40-60. So various combinations are possible. Well, nowadays there is
Sir,
one.
the policy holder, sir, the policy holder, if he invest in the equity fund, then he will also face the losses if any loss income.
Yeah, if equity market
Or
goes down, then naturally the NAV of the mutual fund will go down, and the consequences are also has to be faced by the policy. Okay, policyholders' fund
so the
value will also go
finance
down.
manager who would be in charge, the finance managers who would be in charge, they will not suggest anything like that, or they will help the policy holder in investing.
Yeah, initially, when you opt for the policy, they will be given, you'll be given brief idea. You'll be advised about this is the fund, this is the risk associated with that. Then you have to choose what is the appropriate fund. After that, also, as you know, we can change from one fund to another.
Okay,
Okay,
sir. Yes, sir.
in that
Yes.
mutual funds, what happens? The fund manager of the mutual fund will take care of that fund. Okay, but equity fund means there will be ups and downs. So sometimes market may go up, so fund value may also go up. Sometimes market may go down, fund value also go down. So it also depends at what time we are going to close the fund. If you're closing the fund at a time when market is high, then you're getting more return. If you're closing the fund at a time when the market is low, then you'll be getting less return because fund value is less.
Yes, sir. Sir, the return he will give, he will get the return means every time the dividends come out means every year, or
You see,
he will get.
this is we are learning ULIPs on. This is a policy on. So in this
Yes, sir, it
policy,
is a policy, but here also the return also it is involved now. So that's why I'm asking.
return means return will be distributed by the insurance company. Insurance company
Uh,
will be investing money in a fund. Then whatever return that for the fund that will be received by insurance company will distribute it to the policyholder. So not like dividend.
and yes, sir,
Because directly
that is what I am
policyholder is
asking.
not buying units. Who is buying the units of
Maybe
mutual fund? It is the insurance company who is buying.
yes, sir. The insurance company will be getting the return every year when the
Yes,
company gives
yes.
dividend. So when the policy holder will get the return, means when
Policyholder,
after.
according to the terms of policyholder will get the maturity value. Okay, policyholder in certain, let's say, accident cases, it will get, you
Yes,
get
sir.
the compensation. Okay, policyholder get according to the terms of the policy. Got it?
Yes, sir. Oh, yes.
Now, friends, you see there is one more kind of policy which is called as the 4G policy or 4G ULIPs or new generation this ULIPs or whole life ULIPs. This is almost similar to this kind of ULIPs which we have learned. But the additional thing is that under this 4G ULIPs, they remove certain charges. So this is more useful. Certain charges like let us say return on mortality charges or maturity premium allocation charges. So at the time of maturity, the insurance company removes these charges. So consequently, the policyholder gets more money. So this is the advantage of this 4G ULIPs. Yes, friends. One more kind of policy insurance plan we need to learn is about money back plan. Under money back plan, what happens? The insured person gets a percentage of sum assured on regular intervals. Okay, normally what happens? Sum assured is received at the maturity. But if it's a money back plan on regular intervals, maybe after 10 years, someone will be received, after 15 years, some more money will be received like this. Okay, maybe in every 5 years, some money will be received. That's why it is called as the money back plan. Okay, the is the chief benefit is liquidity. At the time of requirement, you'll be getting some money. Suppose you are planned, you are investing after 5 years, you're getting some money. After 10 years, you're getting some more money. After 15 years, you're getting some more money. So the policyholder gets the benefit of liquidity. People who are risk averse, who do not want to take more risk, and who wish to save through insurance plan can maintain liquidity throughout the policy period by taking this policy. They can pay premium, but at the same time, they can get money back on regular intervals. In case of death, the nominee gets the entire sum. And here, without deduction of the survival benefit. So this is, you can say, it's the investor gets dual benefit and gets money back. It also gets the maturity value in case of death. So this is the advantage of this policy. Understood? Yes, friends. Now, having understood this kind of policies which are there in the syllabus, now we'll move to one more concept which is called as the bank assurance. This is a concept. This is not a type of policy. In fact, bank insurance means insurance policies are, you can say, sold through banks. So bank assurance is in fact it's a French term. It means the relationship between the bank and an insurance company. And because of that insurance company, that insurance companies offer their products. Because of that relationship, insurance companies offer their products through the bank to the customers of the bank. Right. So in fact, you can say otherwise, in other words, you can say bank sells the insurance product of an insurance company to its own customers. Right. So if you refer to the meaning which is given by IRD, bank assurance refer to banks acting as a corporate agent. Your bank would act as a corporate agent to distribute insurance. It is an arrangement between the bank and insurance company, allowing the insurance company to sell its product to the bank's client. Insurance company sell its own product to bank's client. Okay, by doing this, both the companies earn profit. Bank earns its commission, insurance company also gets product. Okay, in fact, insurance company uses the customer base of the bank to sell its product. The typical feature of this system is that bank cannot pay a premium on behalf of the customer. Premium has to be paid by the customer. Bank will not pay. It can use only two insurance companies in one bank. One bank can deal with maximum two insurance companies. All commissions are disclosed in the annual accounts or annual financial statements of the bank. Bank always focuses on the banking business. Bank is not supposed to focus on the insurance business. For the insurance company, the network of the bank is useful to sell its own product. So insurance company uses the customer base of the bank to sell its product. It improves profitability of both the companies. It increases customer lifetime value. So these are the permanent customers. It can offer all financial facilities at one roof. That bank can deal with the customer's account. It can also sell insurance. These are the types of bank assurances. Under life products, you can find term life assurance plans, endowment plans, ULIPs. Under non-life insurance, you can find health insurance, marine insurance, property insurance, and key man insurance. Okay, friends. So these were some of the insurance policies which are there in your syllabus. I wanted to understand this thing. Is it clear up to this?
Yes, sir.
Okay. Thank you very much. Hope we have understood these concepts. Thank you